I'm Zach Zimmer. On today's episode, we're going to be getting into private equity. Private equity investments. You could heard these called syndication, limited partner agreements. We're going to be talking about specifically the ones that include significant tax benefits. So things that offer you large depreciation, cost segregation, bonus depreciation, differently than another episode where we will talk about private equity investments that do not provide accelerated depreciation and tax benefits. You can find me at realzachzimmer.com. And thanks for continuing on as I get more comfortable talking to no one yet anyone in the world, as I've said, and you're getting along with the journey with me as I teach you the tips, tactics, methodology, the learnings, the lessons, everything I've had to go from $20,000 to $60,000 a month in net income, nearly all tax-free. Today, we're going to talk about alternative investing, so private equity, limited partner syndications, whatever you want to talk about, or however you want to call them, rather. We're going to talk about specifically ones that provide tax benefits because some do, some don't. So today's episode is more for when you have more money than time. So as you've heard me talk in the past, when you are newer, you have to keep that money moving. Right? Putting it into an asset, getting it back out, generally through leverage, through placing longer term, lower interest debt. And then you have that money back, but you still control the asset and have that cash flow. So you need to do that for, maybe for 5 years, maybe for 10 years, maybe it takes you 15 years, however long it takes you until you get to a point where you have enough cash liquid that you can, I call it, put to sleep, that you can put it into a private investment because you can't get that money back out immediately. It's going to be in there depending upon the types that we'll talk about. It could be in there for, maybe as quick as like 2 years, but generally more of the 3, 4, 5, 6, 7 year terms. And you have most of the time no control. You have no ability to pull out when you go into most of the things that we're going to talk about. Now, there are some things that we'll talk about, funds, where maybe you have a quarterly option to pull out. But most of the things we're going to talk about today are investing into hard assets that are not liquid. You can't pull your money out in 3, 6, 12 months. It's going to have some type of liquidity event that you have no control over. Again, you're a limited partner, but it'll have some type of planned event that the sponsor, general partner would be talking about or be instructing in the pro forma. So let's first talk about probably the most widely known one is a real estate syndication. And that's actually, those are the first ones that I got into. And that would have been, let me look exactly so I can talk. So my first one was in 2019. And so if you listen to the episode where I talked about where I had the net income charts and we talked about the growth, you'll recall 2019 was when I stopped working. 2019 was the year when I had my final layoff and truly started living the passive life off those investments. And that was the first year, kind of combined with higher real estate prices. The prices had continued getting bought up, more and more investors locally, right? When I started in 2012, hardly anyone was investing. Now in 2019, just because of forums and podcasts and webinars and coaches, and especially national data sets and publications that would tell folks, man, look at Ohio, look at Northeast Ohio's rental returns. We're in the top 5 in the country. So yes, we had lots of outsider money flying in. So that was raising prices. So I had been used to buying properties for 40 or 45,000 all in. Maybe that was a 30,000 that needed 12,000 to repair, or maybe it was a $42,000 turnkey. But I was used to grabbing properties like that and renting them for $1,000 a month. And after debt service, cash flowing $450, $500 a month. In 2019, that became harder. It became harder to hit that. And I also felt like I had enough. 60 some single family homes throughout, Stark and Summit counties in Ohio. And I felt like that was enough. It was harder to do. And there was probably a little bit of that's not sexy versus the syndications and owning, pieces of things much bigger, much better, much cooler to talk about. And so, yeah, in 2019, I did my first syndications, and they were in the hospitality side. And so when you go into a real estate syndication, you get most of the benefits that you do when you own things yourself. No, you don't get your mileage and a lot of those other things, but you are going to get the biggest one, which is depreciation. And the other thing that you get in a larger, normally more units, cost segregation. And some people will say they cost segregate their single family homes, but it's not something I've gotten into. And you'd really have to assess the benefit to say if it's worth paying $1,000+ to do a cost segregation on your single family. But anyhow, these big apartment complexes, or in this case, this was hotels, hotel, winery, golf course, with great folks, by the way, Josh and Melanie McCallan, Accountable Equity, great folks doing great work there. They've turned this place into almost like a giant Disney World there with all the activities. But so they did a cost segregation on that resort. And, I can't recall, I don't even know if I know the exact numbers, but let's just say they raised 10, to keep numbers round, like they raised $10 million and took out $90 million in debt. Okay. So they had a $100 million asset, and they did a cost segregation on that asset. And again, these numbers are much bigger than what it actually is, but just to keep it easy, right? They raised 10 million, they bought it with 90, it's 100 million. And then they do a cost segregation. And I believe what you could find out, generally these cost segregations are somewhere in the 30 to 40%. And so what that is saying, it's saying 30 to 40% of your value is in cosmetic things that you can use bonus depreciation and deduct it in year one. So fixtures, appliances, furnishings, carpet, paint. I don't know. I'm not going to talk like I do know all the exact things. But so in that instance, right, if that was a $100 million building, they may have told them 40 million can be a cost segregation. You can get that deduction in year one. So it gets to all the people who came in for that 10 million now get 40 million of depreciation. So you put in $100,000, and that one's a little excessive, but in that example that I'm saying, you invested $100,000 and you got a $400,000 deduction, right? How is that possible? Debt leverage. You get the deduction against the leverage that was used with your investment in that resort. So there, right, you're getting a huge deduction to offset other passive income. Right, you put in 100, but you got a 400. That was a little blown out. I think some of my examples have been where I've put in 100 and gotten closer to 200 or 250 in passive losses that first year in a cost segregation. So that carries over to all my other things. You get a K1 from them, and that carries over to all your other passive income. So that's how you can have no taxable income by getting these things. And that you got to feed the beast. They say as long as you keep doing those, right? Buy till you die. Heard that. Buy till you die and then pass on, and your estate gets a step up in balance basis. And so the cost segregation is huge to not just deduct any of the income from that investment, but to go against your other investments. So when you are doing this process, you're going to build up a large amount of passive losses, and those carry over. So don't feel like you lost them. They will carry over into future years. But so that first resort, right? I went into 2 of their resorts, got great cost segregation, and that continues to make all my other income disappear. So I've done a similar thing. So apartment buildings are treated the same. I'm into apartment syndications. I'm into commercial syndications. So these are commercial build-up developments, and these are more and you get to pick the location too. So I like to go to locations out west, down south, to go to areas that tend to be better growing areas than Northeast Ohio, right? I'm already own enough direct real estate here, so I try and do my syndications south and west. And so why not diversify while I'm getting that different tax aspect of depreciation? So apartment buildings, commercial, hospitality, that's all going to be treated the same, with an ability to have a huge cost segregation up front. And then after that, yes, your depreciation moving forward would be lesser, because now you're dividing out the rest of those years by a lower basis since you just got a 30 or 40% deduction. But if you keep doing one or two or three of those a year, every year, right, you'll continue to make sure you have tons of excess depreciation to offset other passive income. So that kind of covers apartments, hotels. I mean, anything in that kind of space gets those same type of benefits. So let's talk about another one, ATM machines. So these are interesting. Now, I've heard of some folks, or have known one who actually physically owned an ATM machine or two, and they, would negotiate contracts. And yeah, you've got to come out of pocket for your cash. You have to supply the cash. So that model, I'm not talking about something like that. I'm not familiar with how that even works. I'm talking about investing into a fund that basically goes and puts in new ATM machines or buys up ATM machine contracts, and then this fund owns them. And so they have a buy-in, I believe it was like 50,000, 55,000, which is considered like a machine, an ATM. So you can do it in increments like that. And the unique thing with how they do these ATM syndications is they give you a large preferred return. So most of the ones I'm in are high preferred return, and it cash flows for 7 years and then it's done. So it's a very different model. But the ATM machines were considered like a personal type of property. So they were part of the bonus depreciation of 100% deduction the first year. So if you put $100,000, 105 or 110 to do two ATM machines, you got that whole thing as a deduction that first year. And so those have been very juicy for folks to, hey, jump into like in October, November. Hey, I'm looking at all this, like looking at this taxable income, I need to drop that down. And so that's where those become interesting, when you can find those and get them at a good return. I mean, you can look into some of the other things, like how long do you think cash is going to be around? And you can debate all that. But I have felt I've gone into them twice, and it is a 7-year term. So, you got to be comfortable that cash is going to be used for the next 7 years. But I'm not trying to talk about the validity investments here. I'm just trying to talk about the tax benefits. And you can do your own research into whether you like it as an investment, or you can email me some questions. And yeah, I'm always looking for questions for the podcast. So if anybody wants to email those through, I'm glad to talk more specifically. But yeah, you have to like that as an investment versus just doing it because of the tax savings. So ATM machines are another one I'm in. And then lastly, another different type of syndication with great depreciation and tax benefits, oil and gas. And there's lots of controversy in this area because there's been lots of snake oil salesmen, lots of questionable operators. It's a interesting ripe space opportunity for call it direct fraud, but for just operators over promising, under delivering, because there's a lot of uncertainty in oil and gas exploration. I went into one fund and I'm not too happy with, it was definitely oversold for what they were promising. They've completely missed targets, and the communication's pretty rough. Now, this was an established operator. This particular operator, the owner of the company, has been on CNBC a bunch of times. So that maybe I mistrusted that they do more validity in their checks, but it's not fraud, but this operator has way missed of what they were modeling to pull in cash for these investments and what they were targeting. But you do get in oil and gas, it's 100%. And here's the key, the other kicker. So this is the only type of a passive investment where you're considered an active partner in oil and gas. So it does go against your active income. Now, I don't have any active income. My income is all passive unearned income. So, I still get it as a deduction. I just not using it against active. It'll just go against and add into my buckets to continue to roll over of all the excess losses I have that'll just continue to roll over to when I do have excess income that's beyond all my standard deductions. So those are the three that I am most familiar and invested with. There's probably some others, but I don't like to talk that much about things that I don't know or I'm not into. I'm never going to be one to recommend something that I also don't invest in. So some of these weird quant Bitcoin funds that you need to be a qualified purchaser, which is even above an accredited investor. I'm not going to be the guy to talk about that because I don't understand it. So really, yeah, just, limited partners in real estate where you're getting the cost segregations, the ATM machines where you get that 100% bonus depreciation. If it does roll back again, it would be at that 80% then, and you're getting steady cash flow. That's a very interesting, compelling return profile on ATMs to look at. And then oil and gas as that 100% first year loss that also will roll up against any active income, but be very careful. There's a lot more opportunity to lose your money or totally miss projections in oil and gas than in real estate, in my experience, in my opinion. So that's it. I'm going to make this one a shorter one today. We will do another episode on private equity that does not get as many tax benefits as these ones did. So be on the lookout for that one. All right. Thanks. If you have anything else, you can reach out to me at realzachzimmer.com. Thanks. Bye-bye.